Hi everyone, and welcome back to the E-commerce Impact Podcast. Today we've got a really awesome guest. Andrew Leahy is here to talk to us about getting investment for your e-com brand. When is it the right time and how do you go about doing it? So welcome along, Andrew.
Hello. So much for having me on this podcast. I'm really excited to be here. This is one of my favorite subjects.
Yeah, and excited to have, this is I think our second New Zealand guest ever. Although you're an American, you do live in New Zealand, so that's pretty exciting for me. We're on the same time zone for once, which is awesome.
That's
cool.
Right.
So why don't we start by, if you want to tell the audience a little bit about you and your background.
My name's Andrew. I live in Takapuna outside of Auckland in New Zealand. I wanted to start with sort of my origin story as a founder, what I've gone through in terms of raising capital for my businesses, including my e-commerce business. And then I became a venture capitalist for 7 years, and now I'm here in New Zealand. So I wanted to talk to you about my background because I think that's how I connect most with founders, is letting them understand, like, I've been in your shoes. Like, I've went to investor meetings and got turned down and got people to say yes. So in 2007, I was 19 years old, and I started a music technology company called My Band Stock. It was a stock exchange online for musicians. We morphed that sort of into a crowdfunding model for musicians to raise money from their fans and sell CDs and concert tickets and stuff like that. But we raised capital and moved to Los Angeles. Like many startups, it didn't work out. So we had to tell our investors this wasn't working out. It was a crazy foundational moment. I was like 23 years old in Los Angeles doing that. And then we all just went and joined startups. So I joined 3 different startups over the course of about 4 years. I left the last company as a product manager to go back to school because I left my University of Michigan, go blue, to run my startup. So I went back to school. And when I went back to school, because I couldn't help myself, I had to have a startup while I was in school. So my brother and I started snapsuits.com, which was custom suits for $250 delivered in 14 days in 2014. And so we bootstrapped that company with a couple other partners. And it started off, we got to get a website, we got to do a photo shoot, right? So we had a defined, very unique category, which was custom suits. They were delivered quickly, and anyone that was having a wedding could customize the way they looked, right? So we bootstrapped the company. We started getting a lot of momentum, and we started buying some Facebook ads. We had multiple channels going. And then, what was interesting was that what we realized really hurt us was how long it took to receive our orders. So we had this really high, amazing acquisition channel, but then sometimes it would take us 9 months for that cost to acquire a bride or a groom, which was about $200, and the yield was $2,000. So the problem that we didn't really think about was how long it took our marketing to actually hit the bottom line, right? And so as a result, and we couldn't quite raise more money, we were having meetings, we were getting investment, but we just couldn't quite raise more money. We did 2 million in sales, so we didn't do like too bad,
Yeah.
It wasn't like a tiny thing. After that, I went to start a venture capital firm with some folks over at Hawk Media in Los Angeles. We ran for about 7 years. We had a $30 million fund under management. We invested in several consumer companies, but we mostly invested in the software side, the marketing tech side. So I've always been very deep in the tools and the channels and the strategy around acquiring customers and acquiring them profitably, right? That's a really important part, and a lesson that I learned myself very early on.
Yeah. There's nothing like learning in the weeds of a real business, right? And being able to like figure out how things work and, what business models work, etc. Awesome. All right, so let's dive into our topic. So my first question for you is, from your perspective, what are the foundational elements you believe an e-commerce brand should establish before seeking investment, before they even kind of start considering it? What elements signal readiness and potential to investors?
Sure. There's a lot, but I kind of narrowed it down to 4 that I think are the most important.
Yeah.
Number 1 is uniqueness. Number 2 is the metrics showing demand and what the business is. Number 3 is brand. And number 4 is story. What is the story? Who are the founders? Why is this being created, right? So on the uniqueness front, look, why are you in market, right? Are you just selling like another chapstick, right? Like, I can get this at the store. What is the reason that your product is unique and that it can exist in the market, right? So that's like number 1. I remember looking at a company that's based out of New New York called Lalo, and they were building really unique child toys and strollers, and they built these beautiful high chairs, and they had as well as a jogger that was for their product as their product. Super unique product, really beautiful. They went on to do extremely well. They've been around for 5 years now, right? They did a great job defining what made them super unique, right?
Mm-hmm.
The metrics, right? So if you're going out for investment, right, and it's not friends, family, or fools, which is the first kind of people that you talk to when you're getting a business off the ground, you gotta have some metrics for the most part. I think there are some investors that may, write a check before you have metrics, but a lot of times when we were pitching in products that I've seen, it's really important to show that sort of growth momentum that people are buying, that people like it, there's reviews, right? So the metrics are important. The third thing is your brand, right? Like, what do you represent? How does that tie into your uniqueness? And what makes you special in terms of the way that customers feel, right? When they look at your website, when they buy your product, that's important. And then the fourth is story, right? Why did you create this business? Why are you going to work 90 hours a week to make this business come alive, right?
Mm-hmm.
If you developed a tool for cancer patients because your grandmother and your mother died of the same cancer and you're just alive with this mission, right? That's really important versus like, well, my friend pitched me a custom suit idea and I needed a job at the time. So like, yeah, my brother and I decided to take it on,
Yeah.
which
So
is my story,
you're
right?
talking about the story that you're telling investors versus the story you're telling customers. They're probably quite similar, but there's a nuance, isn't there? So
There
you have to
is.
have
Yeah, it's the
developed this.
why.
Yeah.
It's the why. Yeah,
Yeah.
exactly.
It's the why you would be the perfect person to scale this business and why they can trust you and why your story means that you're going to care about this more than being distracted by some other idea. Yeah, that's really
That's
interesting.
exactly right.
So what you're kind of saying here is that like you can't go to an investor when you haven't really figured out the brand or you haven't really figured out the product market fit and you've got some sales but they're not consistent. You're not really, consistently getting people repeat buying. You need to kind of figure that out. So product market fit, like mature brand or at least well developed brands
Mature,
maturing. Yeah, exactly. So you might have tried a
developing,
few things,
right?
you've like pivoted it
Hmm.
a little bit and you've figured out something that's working pretty well. So that's the stage when you're looking to go to an investor. Okay. And what about, just to change tack a little bit, like
Sure.
to take a little step back, investment versus bootstrapping versus straight up borrowing, because there's lots of borrowing options for e-coms now.
Yeah.
Like, what are the
Yeah.
pros and cons here, and what would you advise a brand, you know, how do they choose which route to go or when to take which route?
Yeah, sure. So I'll attack the last one first, borrowing. Do not use the Shopify borrow button.
Okay.
It's one of these crazy options that exists for all these store owners, and there's actually a lot of discussions happening online about how it's really hurtful to the brand owners to take this money that's a high interest loan, and it just comes out of your bank account after purchases. There's been calls for Shopify to like just end that business and focus on payments because it can tend to really change the dynamic and the way that you run your business. If you have a crazy profit margin, right? Like you're selling a pencil for $30, then, and it doesn't hit your bottom line very much, okay, like consider yourself lucky, like borrowing might work for you. But if you're one of those brands that's got a 50% margin, a 40% margin, and you're borrowing and you don't have like an insane amount of repurchasing rates or subscriptions or whatever it is, you can get into a hole really quickly. So I try to keep people away from borrowing unless it's like a ridiculously tiny payback rate, which is extremely hard to find or near impossible.
Mm-hmm.
That's number one. Bootstrapping. Bootstrapping is my favorite way of starting and running a business. As an ex venture capitalist, I know that I'm looking for the highest return possible in a company that I'm investing in, right? And the truth is most of those companies end up failing. Most of them don't end up being as big as you thought they were going to be, and it's a big risk to invest, right? So what happens with bootstrapping is you're really able to every day wake up, look at the costs, focus on the revenue generation, and just like really get working, right? Now, investment's great. It helps you with pay employees. It helps you invest in more R&D. It helps you invest in marketing. There's a lot of great things that happen when you invest in a company, but what we typically find is that investment changes the way that you approach the business. And this is a big problem that has sort of happened over the last 5 years. Company raises a big round of funding, they hire all these people, they start spending on all this growth. And then they just find out that like whatever they were trying, they were spending too much money on, whatever customer they were trying to acquire wasn't the right customer, right? And so like it's a very careful balance of taking on investment versus the bootstrapping. And then the borrowing can get you into trouble. So it's just some things to keep in mind, as you think about what are the three avenues that I have.
Mm-hmm. Yeah, for sure. Yeah, I mean, the bootstrapping route feels like the most, like, the one you can guarantee the best that, it's not going to go wrong and you're not going to end up with the wrong people. But the downside to it is if you're really ambitious and you want to grow and you want to have, maybe you've got first mover advantage and you want to get ahead of the competition while the opportunity's there
That's
before the
right.
copycats come, then that's
That's
not
right.
always the best way, right?
Well,
Yeah.
if you have a really crazy, unique product, you have IP, you've developed this scientifically based thing that, and you want to sell on e-commerce, like that's how you raise investment dollars, right? If you're selling, if you're a new t-shirt shop in town, like, it might look really cool, but like good luck, So there's a lot of variables that go into that, right? I always talk about like, the woman and husband couple that's making candles, down the street and has a nice candle shop, right? Like don't put together a deck for venture capital, most likely, right? So just really have to keep in mind, like, where do you fit in the space and what kind of high growth profile can you actually achieve? And that's where investment comes in.
Yeah. The candle, that's funny that you mentioned candle business because that's always the example I use. Like, I get a lot of candle
You
businesses
both
come to,
use,
I'm like, what, how are you different? Like, if you're in a
yep,
store and people can smell it, sure. But if you're online, candles are tough. Alrighty, so investor alignment, that's another kind of hot topic. So, what are the key
yes,
factors you'd recommend e commerce founders consider when looking for the right
yes.
investors? And how important is it that the vision is aligned and the kind of philosophy around, how you plan to do things is aligned?
Yeah, it's really big. It's super important, right? There's four things that I think are really important to think about with investor alignment. So number one, alignment with the mission, right? Number two is that they have to be early stage leaning. They have to understand the early stage startup, sort of problem solution circuit. Number three is a history of investing in consumer. Don't approach a software investor or a, private equity, person who buys industrial businesses or something unless they're one of the friends, family pools. And then region specific can help, right? If you're in New Zealand, who are the investors in New Zealand investing in New Zealand, right? So I'll start with the alignment and mission, right? There's a lot of investors out there today, especially in the last maybe 3 or 4 years, but they've come out to say, we are here to support the climate crisis, right? And maybe you have this really cool plastic that you've developed that decomposes in your garden, right? There's a bunch of startups in New Zealand that are kind of like that, right? How do you align the fact that you have this product that helps with climate change with investors that want to fix climate change, right? Like align that mission. That's important. And so what's good is that a lot of the venture capital firms out there, a lot of the sort of grant money that's out there, they're pretty specific about what they invest in and the problems they want to solve. And you can also check it up because the investments that they've made, you can feel that alignment. If you invested in this company, well then you'd probably actually be interested in mine, right? That's one of the things I teach in pitching investors is like find a company that would align mission wise or in some DNA with what you're doing. And then, that's a great way to get introduced. Early stage leaning, don't approach a late stage investor or an investor that they write $5 million to founders, right? In healthcare or something, right? So early stage leaning, make sure that you align on the timing perspective, on the stage perspective of the investment. Number three, again, history of investing in consumer. Make sure that that's aligned, right? That's somebody who invested in, Harry's and invested in Dollar Shave Club and you're a subscription company. Like that's good that you have alignment like that, right? Now you got to
Mm-hmm.
prove a lot of other stuff to get them to get on the phone with you. And then region specific, right? I've seen this in the US, I've seen this in New Zealand and elsewhere. There are investors who say, we invest into these regions. We are backing companies in New Zealand. We're backing companies in Australasia, right? Or we're backing companies in Japan. So make sure that a lot of times when you're first starting out, getting those region specific investors can be very, very crucial.
That's interesting. And actually, I've thought of a supplementary question to that. What are the types of
Sure.
investors? Because you come from a VC background, but that's not the only option, and there's definitely some cons to that too. So, do you want to just outline for those who are kind of new to this what the different types of investors, the buckets they typically fall
Sure.
into, and some of the pros and cons?
Sure. So it's the way I think about it is that the sources of capital are all based on like what their investment strategy is. So if you're an angel an angel investor, there are angels out there that are backing people for as little as $5,000 for an angel investment, right? There's some angels that put $250,000 into a deal, right? So the angel investment category is the strangest because they sort of live under a rock and you have to get introduced to them. And they're not always super clear on what they're investing in. If they do it a lot and they're professional and they have a website or an angel list profile, you can kind of see some of the stuff. But angel investing is personal capital, right? It's I made a chunk of money, I have it set aside, I do deals, right? So then
So
there's venture
that's so
capital and
an
oh,
example
go
of an
ahead.
angel investor, would that be like your Dragon's Den, or what do you call it in the Shark Tank? So that's like an entrepreneur who knows some stuff and they've
Yeah.
got some money and they're
hmm
investing in that
And
business.
yeah, and there's usually angel groups. There's a bunch here in New Zealand. There's a lot in the States. They come together every month. They look at deals. Somebody reviews deals to bring to that committee. A lot of times, deals, when they first start off, they come to these groups and they get feedback. And you might get someone who says, I really align with your mission. I'd love to support. I know it's only $10,000, but like, I just want to support you. Right. So I always say, ask for feedback, get money, ask for money, get feedback. Always remember that quote. But yeah, and then you have the private equity world, and private equity falls under is actually kind of encompassing of both private equity firms and venture capital. And private equity manages other people's money. They say, give us your money. Here's our investment profile. This is what we're going to do. And by the way, here's kind of how this should return to you, right? So when you're pitching a deal to the private equity world, they're thinking, how do I make money from this? How do I sell this later? How do I help this grow? Right. So they're fitting those parameters of returns they have to make to other people. Right. And then you have the grant world and you have the government money world and the Callahans of the world here in New Zealand. You have these other groups that are basically funneling some sort of public money, nonprofit money, grant money, typically for economic development or some sort of mission-based financing, like solving the water crisis or solving the climate crisis or
Mhm.
whatever it is. And so the source of the funding is very directly impacted on what their expectations of you and what this company and what your mission is supposed to become.
Mhm.
And then there's banks, which they don't fund people unless you have a ton of revenue, and don't go to a bank if you're really early stage, and that's not really a sufficient source of capital. That they can provide credit lines and capital lines later. There are a whole slew of stuff that will try to offer you capital and credit and lending online. Most of it's really bad. Again, I try to keep people away from borrowing because it's a quick gap to be underwater.
I think now with interest rates the way they are, that's really sound advice. A few years ago, when you were getting like 1 or 2%, it kind of maybe made sense. But yeah, I think it's going to sink you pretty
Yeah.
quick at the rates we've got right now.
Yep.
Yeah, that's awesome. That's good to know the different, because even just knowing the terminology and the different types is really important going into this, right?
Sure.
Yeah.
Absolutely.
Cool. So, in terms of valuation, from your experience, what are the common challenges that brands face when they're trying to even figure out how to value their business? And like, what is a good way to look at valuation?
Absolutely. So there's kind of four things that are really important that they're kind of the biggest things that go into valuation. It's the strength of the founding team. Who are you? What have you done? Why are you unique? Why are you like special, right? You got to prove that. The public market trading multiples is a really big conversation around valuation. Like, what is dog food being bought at or being traded at the corporate M&A level, at the stock level, right? There's not a lot of stuff that correlates from public markets to private markets, but people look at that as a comp of what they could achieve or what it might look like 5 years from now. Because all these investments, they're making this investment and waiting 5 to 9 years or more for something to actually happen from it. So it's a very future leaning thing. the metrics and the growth. The difference between doing $10,000 a month in sales and doing $25,000 a month in sales, massive, right?
Mm.
It's the difference between valued at maybe 2 million and maybe 5 million. Like the way that you manipulate and understand what revenue is being generated early is going to very much effectively kind of dictate what your price is going to be, right?
Yeah.
And then IP strength, right? Did you develop a novel device? Do you have a patent? Do you have a partner with a celebrity or an influencer? Like, what are you selling, and what is that packaged together to be worth? A healthcare company that developed a new MRI machine is going to be completely different than like somebody who has shorts that have extra loops on it for rock climbers, right? Just completely different chasms, right? So what is the strength of that IP and the product, and then how does that all marinate up to metrics and public profiles, and then the strength of the founding team? Those are going to be the four most important things to think about. There's a million of them, and
Yeah.
it depends on what your strength is as an entrepreneur and as a company. But
Hmm.
those four things are going to be the quickest way for you to determine what your value really is.
And is it typically done as a multiple of revenue? Like, and then what that multiple is defined by those qualitative factors about like the market, the story, the brand, the product, the IP, etc.
Yeah, it is. It is at a later stage. It's more of a multiple. When we invested in the jewelry company, I think they were doing something like 30,000 a month in sales.
Hmm.
And, we didn't value the company because off of that revenue, because they weren't even doing a million in sales. So like,
Mm.
you know, we also want to preserve founder equity for the next round as well.
Yeah.
So there's a whole metrics around like, okay, well, I can't really reliably own 40% of this company because that doesn't make sense. I can't, own 5% of this company, right? Because it's a lot of money and that doesn't quite make sense either. So it's kind of a relationship and an understanding between the founder and the investor. What is this worth? What makes sense for the stage you're at? What are you going to raise your next round? How much runway do you have? Do you have 18 months runway? Do you have 3 months of runway? So there's a ton of factors. I try to tell founders not to get too caught up in the valuation. It's I'm
Hmm.
raising, here's how much I'm raising, here's what I'm raising for, here's what this gets us. What do you think? What is this worth to you?
Hmm.
I always say like if the investor sees a price and they completely don't agree with it, a lot of times they don't even want to negotiate. Like, well, if this was a $3 million deal versus six, like I'd be interested. Like, you know what I mean? So I think it's important to let the market sort of decide what your price is. And then if you have a handful of investors that say, I'm in, right? And you raise half your round, okay, well, they decided what the price was. And then now your
Hmm.
job is to go find the rest of the money, right? So it's kind of this like seesaw effect that you have to kind of go back and forth and continue to kind of sharpen what the valuation should be and what you want it to be. Because I mean, I just saw a deal the other day, great deal, super highly evaluated, sent it to my VC friend, completely too high of a valuation. No, no thanks.
Mm.
So you gotta have a balance of what you think it's worth versus what everyone else thinks it's worth, right? And the good news
Yeah.
is you only need a couple yeses.
Yeah. Right. Yeah, that's really interesting. So, yeah, being too fixed on what you valued it at is probably a mistake because you'd end up kind of closing the door on potential deals, but more being really clear on how much you're raising and what you're going to do with it. And then the negotiation begins around like what stake that ends up representing for the investor.
That's right.
Oh, okay. So getting into the pitch then, what components of a pitch do you find most compelling when evaluating e-commerce brands? So when you're on the other side of the fan, what tips do you have for founders so that they can make their pitch really unforgettable?
So I focus a ton on this with both in my background and my history as a VC, now with the clients I work with. I love this question. So the number one thing is the story and the narrative, which is like what is the beginning, middle, and end of your pitch? And like, how does that make people excited about what you're doing? Right. So this is one that's really hard for founders to do themselves. I remember back in 2007, 2008, I remember pitching so many people getting feedback. and collecting little bits of information here and there. I think you should emphasize this. I think you should emphasize this. And this is missing and whatever. And so, and it took a long time to do to get this feedback. And once you assembled it all together, you're like, like, okay, this is really it. Oh, now this is working. This is working with investors, whatever. And so it's really important to try to just get a little bit outside of yourself, get that outside feedback, right? And not necessarily like, the the person who lives in the same dorm as you or whatever, but go get feedback from the community. Is this resonating? Is there anything that doesn't make sense to you here, right? And just really continue to get that together. So story and narrative is number one. What is your secret weapon, right? I think it's super important to talk about what makes you unique and what makes your product unique, right? That's always going to be one of the most important parts of your pitch. But you can't spend 7 slides telling people why you're unique and what your product looks like and here's what it looks like on mobile. Like nobody cares, right? If you can't kindergarten speak how amazing what you're doing is different in 2 slides, I always tell people, I'm like, you get 2 product slides. That's it. You don't get 7, you don't get 4. If you do 3, it's too much, right? People think you're unfocused, right? So a good deck, somewhere between 10 to 15 slides. The shorter, the better, and the more succinct, the better. So super important for you to explain what your secret weapon is, but not exhaust anyone, right? Defined industry and market. I had a business school professor that always said, you don't create a new market. That market already exists, right? The people buying from Lululemon, they just used to buy from Gap, but they don't anymore, right? That market existed. Someone else just came and filled it with people who already existed, right? So something that's a really important concept to understand. If something is completely new and no one's ever done it before and it's completely unproven and it's an opportunity, that's really hard to pitch, right? So be careful with that pitfall. And then traction, what have you proved, right? I remember when we raised some of our first dollars, we did a survey that we surveyed like 1,000 people. And it was like an opportunity survey, right? And so we started telling folks like, look at all these surveys we have. People in our demographic, here's who they are, this is what they're interested in. Oh, and they want this, right? Like this is something that they said. And we set up the survey with some organizational studies students who like knew how to do surveys. And it was really powerful and it actually helped us a lot with raising capital. But again, it was some level of market research, market indication that you have to have. And so
Yeah.
sometimes that's sales or repeat sales or subscriptions that nobody turns off. We're 11 months in and our paid cohort's amazing, whatever it is. But it's showing that the market need is being met by your product in some way.
Yeah. Yeah, that's so key. And so much of this stuff boils down to like having a good business, right? Like a good business understands their customer and what they want and what they want to buy and what messages are going to work for them. And like surveying and interviewing is the key to doing that. So none of this work you do for your pitch is going to go to waste. It's going to help you build a better business and help you look at your business in a more stringent way, I guess. So yeah.
That's
Cool.
right. And you can be 40 years old and worked in aviation your whole life and never started your own business. And then you want to start an aviation startup and people won't look at you like you're a 20-year-old who's never worked in their lives. And, that this whole thing that you have to be young to start like all that's like not true. Like you just have to understand your customer better than anyone else. I have no business starting an aviation company. I fly Air New Zealand and Delta, and I have my things I like, but like I'm not an expert in that, right? And so explaining why you're the expert, that's the narrative piece. Understanding your target market and having some traction where people have bought. It's an LOI even, right? I love LOIs. It's a great way to prove that people want your product, right? Because they usually agree to a price as well. So yeah, those are key things. Customer is always the most important focus on actually having this business that can survive.
Totally. So, changing tack again, metrics. What, as an investor, what metrics, what are the like 3 or 4 key metrics that you're going to look at? And what are you hoping to see? I know it would depend on the industry, but like, what are the kind of
Of
ones that are
course.
most common?
Yeah, so when I started thinking about this, there's really like 5 that I think about in e-commerce that are important, and then there's obviously branches that come off that. But you know, monthly revenues, return purchases, ACV, which is like how much is your cart value typically, your ECR, which is how many people on your website are you converting? Is it 2%, half percent, 3%? And then your channel diversity, like where are people coming from to buy, right? And then there's a bunch of other ones that have to do with margin and supply chain and like stuff like that. But from a growth metrics perspective, I'm really trying to get a top level understanding of where your business is at. It's those five things. And so channel diversity also sort of is a metric that goes above, the monthly revenues, the return purchase repurchase rates on a channel level. What does that look like? Are your Facebook users a little bit that are clicking on ads a little bit buying more? Are your users from Klaviyo and your PostScript and SMS users, are those people buying more? How about affiliate? How about your word of mouth channels? How about influencer, right? So I think understanding channel diversity, if you're just killing it on Facebook ads, but you haven't tried anything else, you get a little bit worried about putting a check into a company because you don't know what the ceiling of that is. At what point does that run out? And so the hardest thing for brands, and I know we've talked about this before, even is like managing channel diversity, right? It's hard. It's time consuming. You need content, you need copy, you need schedules, you need someone to do all that. You need someone to monitor all that, right? But as you figure out what works, it's really important to start widening out those channels and experimenting, right? I think it's super important to set aside an experimental budget, experimental time to throw stuff at the wall in a smart way, but to throw stuff at the wall and go, oh my gosh, we just figured out this thing worked. We didn't know that it was going to work, and it did, right? And so, yeah, from a growth metrics perspective, it's being able to see that the operator is really operating the e-commerce business.
So where can our listeners find you, follow you, hear more from you?
Yeah, check me out on LinkedIn. It's /Drew Zealand. And I write basically all the time about startups, raising capital, putting together pitches. I'm always available for a 30-minute consult.
Awesome. We'll put your details in the show notes. Thanks so much for coming along.
Oh, thanks so much for having me. This is my favorite subject.
It's great to have you.